Hello everyone, welcome back to the channel. So in today's episode, I'll be delving deeper into whether or not you should be trimming ASML stock. So ASML just reported their earnings and I'll be running through the company. ASML stock is up around 100% over the past year. In late April, it dipped to around $600 a share. Currently around $1,400 a share. And this is their earnings outlook going into 2026. So they guided between 8.2 billion and 8.9 billion in Q1 of 2026, which is this year. So it's down around 9% in terms of revenue compared to last year. As for their full year outlook in 2026 is between 34 and 39 billion dollars. So the management is actually quite conservative here. The revenue forecast for Q1 is actually down around 9% year on year. The guide for 2026 is relatively okay, so it's between a 4% revenue growth and a 19% revenue growth. And if you were to take the midpoint estimate, it's around a 12% growth in terms of revenue for the firm. So this is how I like to think about ASML. There's two different key metrics that you can look out for. And these two metrics include your backlog as well as your net bookings. So I know a lot of investors, they confuse between the two. So maybe I can try and break it down a bit for you. So net booking is basically when a company expresses the intent to buy the machines. Backlog is when the company is already in the midst of receiving the machines. So you can think of your backlog as remaining performance obligations. You can think of your new bookings as the new orders that is coming into the firm. So new bookings is the top of the funnel. And then in the middle, it's your backlog. And then at the bottom, what comes out is the revenue for the firm. So in terms of the net bookings number for ASML, in Q4 of this year, it actually went up by quite a fair bit. And in full year of 2025, it's around 28 billion euros as compared to net sales of around 32 billion euros. So in terms of ASML, this is normally what I would like to look for. If net bookings is greater than revenue, it's a positive. It suggests continued revenue growth. When net booking is lesser than revenue, eventually what happens is your backlog will dry up and then your revenue cliff will come. In the case of ASML this year, the net bookings is okay. So it's $28 billion as compared to their net system sales, which is this number here minus away this number here, which is suggesting that the net bookings is actually quite strong. So in the case of ASML, net bookings over the past 2 years, in 2024 as well as in 2023, has been lesser than the revenue, supported by strong net bookings in 2021 as well as in 2022. We will have to see continued growth in net bookings going into 2026. I think they're removing this metric. But the core idea here is that they need to maintain the current booking levels in order to ensure sustainable growth into the future, all the way up to 2030. So in order for them to sustain this net bookings number, you can look to find the different growth drivers for the firm. So of course, it's the customers of ASML. In this case, it will be demand from both the memory as well as the logic segments. In memory, it's quite strong. So you have Micron, Samsung, SK Hynix. All these companies are reporting higher capex for this year. They're projecting higher capex. In logic, you have TSMC as well as Intel to a certain extent. So all these companies have forecasted improvement in terms of guidance apart from Intel, which will then trickle down to ASML. So for example, in memory, you have Micron as well as SK Hynix. They're booked out all the way until 2026. TSMC also said, and they hinted to the possibility of 40% increase in revenue for the firm. So as for Fab forecast, you can go and break down the different Fabs that is coming up as well. This is a leading indicator for ASML's revenue. In the case of Fab forecast, new Fabs going into the new years are still positive. So for example, Taiwan is projecting 11 Fabs over the next 5 years. Currently only 3 is announced. So the other 8 are not yet announced. As for ASML, I think the main issue that a lot of investors are facing today in terms of holding the firm, myself included, is the valuation for the firm. So if you look at ASML's valuation, this is the P ratio for the company over the past 10 years. The past 10 years median P ratio is around 35 times. It is currently trading post earnings at around 47 times. So if you are to look at the guidance for 2030, these were just some simple numbers that I put into a spreadsheet here. So net sales, they're projecting between 44 and 60 billion. So the midpoint is around 52 billion. And assuming a 35 times as well as a 40 times price to earnings ratio at the end of 2030, the stock price target will be around $1,800 a share by 2030. And then if you discount it back to today's fair value, it's around $1,100 a share for the midpoint. So what the markets are currently pricing in is the high end. They're pricing in the possibility that AI could become sort of like a super cycle, or high end AUV demand starts surging in from here on out. And it's up to you to decide whether or not the company is expensive. In my opinion, I think the company is on the expensive side. It is not cheap anymore. And currently, valuation suggests upside is likely priced in already. So when it comes to thinking about selling a long-term position, like for example ASML, here are a few different frameworks that you can try and use. The first one is you sell a stock when the thesis is broken. Second of all, you sell the stock when the quality of the company is weakening. Third of all, you sell the stock when there is a better opportunity elsewhere. In the case of ASML, fundamental thesis is not yet broken. So the thesis has always been AI supercycle, US increased Fed spending and increased investments into AI, growth in installed base management, basically providing more stability for cash flows into the future. So thesis is not broken yet. The quality for the company is still extremely strong. So you have your installed base coming in, you have little intensity increasing, meaning more people will need even more ASML machines to make sure that they can fulfill the demand. So I think for ASML, it doesn't quite fulfill the two criteria up there for selling a stock. But the third criteria is where it comes in. Sell the stock when there is a better opportunity elsewhere. And in the case of ASML versus the other opportunities, I think there are other opportunities elsewhere. And I would like to highlight two in this video here. So the first two companies are Visa as well as MasterCard. So I'll be doing a Visa deep dive soon. I've been researching into the company. But here are some of the current fears as well as my pushbacks for all these different fears. So I know the main one out there right now is this thing called your CCCA, which is your Credit Card Competition Act. So over here it says your Credit Card Competition Act breaks card exclusivity. Currently, Visa has exclusive agreements with issuers, shifting the choice of networks to issuers and consumers. With the inclusion of a second network, the decision shifts to the merchant, leaning them towards the lower cost alternative that provides adequate fraud protection and authorization rates. With the top 10 banks making up more than 80% of the existing credit cards, and with all of them having more than $100 billion in assets, most consumers will see their issuer-funded rewards affected if the transaction is routed towards a separate network with lower fees. So if you don't know what a CCCA is about, it's about providing an alternative to Visa as well as MasterCard. So in each credit card in the future, you won't just have one payment rail, you have two payment rails. It's similar to debit cards in the US. So as highlighted over here, what this means is that there is a low-cost alternative to Visa as well as MasterCard. So that could be a negative. So my pushback is this. While CCCA indirectly affects Visa because the presence of an alternative actually lowers Visa's interchange fees as well because they need to make sure that the payment volumes still come in, the impacts are actually mitigated by Visa's unique offerings. So in today's age, Visa's offerings in the form of tokenization as well as Visa Advanced Authorization will help to maintain merchant stickiness with bundled pricing. So Visa's strategy is less about monetizing volumes outside of Visa Net directly and more to make alternative routing economically and operationally inferior, unless merchants are willing to accept higher risk, lower authorization rates, or poorer user experience. So if you don't know what Visa is currently doing today in terms of their value-added services is mainly four different portions. So their first portion is their cloud banking portion, as well as them providing analytics to banks to try and push out more favorable rewards. The second portion is tokenization. The third one is fraud protection. And then the last one is their marketing as well as the consulting ops. In terms of this interchange fees, what Visa is trying to do today is they're trying to provide more tokenization benefits as well as fraud protection benefits to increase authorization rates. So authorization rates refer to how many transactions get authorized, and the opposite to that would be that your transaction gets rejected. So in terms of merchants, what they want the most is, number one, they want to protect against fraud. Second of all, they want the highest authorization rates. So they don't want the cards to be rejected. And in the case of Visa, this is what they're trying to push today. So adding on to this, should merchants push back on Visa cards, there are mitigating revenue streams that Visa can tap on to drive its revenue. So the new CCCA Act does not lead to a reduction in Visa cards introduced. Instead, it recognizes two networks in one single card. And currently now, the alternatives, they don't have any rails. So in terms of rails, there are two different types of rails. You have your single message rails, you have your dual message rails. In the case of credit cards, you need dual message rails. And the only company that is currently able to provide this out of these three companies here is Discover. Star doesn't have it, NYC doesn't have it. And in the case of Discover, they were actually acquired by Capital One. So sort of this incentivizes issuers to issue their cards anyways. So this control limits Discover's appeal to external issuers due to lack of control over rules and data for the cards. So I don't think there's much of an alternative to Visa as well as MasterCard today. And in the case of CCCA, I think it's overblown. There's very minimal regulatory pathway towards approving this regulation. The next company that I view as interesting today as well is Netflix. So Netflix is a company that I recently added into. So I believe that the Warner Brothers Discovery acquisition will continually push down the stock and provide downward pressure. And the stock will probably continue this way until they close the deal. But if you're to think in terms of first principles, simple thinking, if you look at the Warner Brothers Discovery acquisition, you can frame it this way. So we saw growth in streaming over the past few years already. The growth phase is currently now gone. We saw 20% plus growth in terms of all the different firms across the entire streaming industry because of COVID. Currently, what we're seeing is something called consolidation. So where companies at the bottom will struggle, and then the companies, when they struggle, they will look for acquisitions, strengthening the dominant ones at the top. So I believe this is what Warner Brothers Discovery is doing in terms of selling their own firm. And there are two main things that will drive streaming dominance in the future. So first of all is subscriber as well as scale. So because you have scale, you can improve efficiencies, lower the cost per subscriber. Second of all is content IP, how much content a company has, how much timeless pieces of content they have in their library. Amazon did something similar last year. They bought MGM, about 1/9 the size of Warner Brothers Discovery. As for Netflix, what they're trying to do is something similar here. So they're trying to drive longevity by buying content assets directly, which is what will determine the streaming industry in the future. So free cash flow will be around negative $1 billion for this acquisition. It's not accretive for the first year. This is based on my calculations. So working back the numbers, the ARPU is around $144. The free cash flow margin now is around 21%. Of course, this number can go a lot higher next year. They will need around $33 million to gain and break even on this acquisition. So it's around a 10% increase from their current subscriber level. This is possible given that Warner Brothers Discovery as well as Netflix combined has around 450 million subscribers. And they could do bundling deals as well to try and cross-sell over from one platform to another. So the streaming industry is going to continue growing and steal share from cable. This is something that won't stop. So the simple question here is who is going to win in this industry? And in the case of the streaming industry, I think Netflix will do well. And on pricing, last of all, is that if you look at Netflix ad tier pricing as compared to competitors, excluding bundling deals, it is actually one of the lowest ones. And you might have a catalyst there if they increase the prices next year. So we'll have to see. In the case of ASML, I'm actively looking for opportunities elsewhere. I think the company is expensive right now, and it might not be a bad idea for you to trim. I hope you guys have found this video useful, and I'll see you guys soon.